Let's bring on your next panelist here. Your next, I guess, host of the next panel is Bloomberg editor Jakob Peterseil. He's going to bring up our next speakers. Jakob?
Good morning, everyone. Welcome to our second panel of the day. My name is Jakob Peterseil. I'm an editor at Bloomberg News. I sit on our cross-asset team in London, where we end up writing a lot about ETFs, and there's a pretty simple reason for that. The industry has been growing by something like 20% a year over the past decade. Today, ETFs hold more than $5 trillion globally, which is the kind of big round number you can't really ignore. It's a growth trajectory that's made a lot of ETF issuers and index providers very happy, perhaps even investors. But it's also, as Matt alluded to, given some fodder for critics who say that some of this growth may have come too far too fast. They're asking questions like, have ETFs made markets more fragile? Have ETFs been adequately tested by something like a sell-off in high-yield bonds, for example, or loans? So today I'm hoping with our panel we can hit on some very practical questions about trading ETFs, but also some of these big picture issues about whether ETFs have in fact made markets more fragile. And we've got a great panel to help us do that today. So I'll call them up as we go. So first we've got Thomas Merz. Thomas is head of European distribution at Vanguard, where he oversees the firm's strategy for ETFs here in Europe. So welcome, Thomas. Thanks for joining.
Good morning.
Good. Next, we've got Slawomir Rzeszotko. Slav heads the institutional sales and trading for Europe at Jane Street. Jane Street, as you know, is probably one of the biggest ETF market makers, if not the biggest. So welcome, Slav. Good to have you. And finally, we've got Rajendra of Deutsche Bank. Ari heads the European Synthetic Equity Strategy Group. So it's a group that's advising clients on a range of Delta One strategies, not just ETFs, but futures, swaps, things like that. And his group also produces some influential ETF research. So welcome, Ari.
Thank you for having me.
Okay, Slav, I thought maybe we could start with you. So I think we've established that active managers are using ETFs. They're not the enemy. You deal with institutions every day. So would you mind running us through a little bit about the types of institutional users you see of ETFs? Are they mostly the buy and hold variety, the tactical trading variety? And just give us a run through of some of the ways your clients are using ETFs today.
Absolutely. Good morning, first of all. It's a great pleasure to be here. The question is an interesting one because it keeps coming up, and often it comes up in a format that is phrased less nicely, meaning we often go to conferences or meetings and somebody says, well, I'm an active manager, why should I use an ETF? And it's really puzzling because when I look at the breadth and scope of clients that we trade ETFs with, most of them are active managers, in fact. Right? There's very few indexers who would use ETFs in large scale in building their portfolios because, in fact, they are paid to index, right? So why would they use a building block? It's very different with active managers, and it's not only active managers, it's the whole spectrum. So I think typically we have seen in Europe that the market is less retail and more professional when it comes to the usage of ETFs. Asset managers, the active teams, the multi-asset teams were probably the first adopters when they were using ETFs for asset allocation purposes. But we see this increasing. We see real asset owners and institutional clients getting involved as well. And what really strikes me as very interesting is that when we did our global ETF trading study, which some of you may be familiar with last year, we asked, in fact, 200 clients globally, why do they use ETFs? Why do they trade ETFs specifically? The top response was for tactical purposes, which is maybe not so surprising. But the second most popular response was for core asset allocation. So really two opposite sides of the spectrum covered here. I think the fact that ETFs can be used for core asset allocation really speaks to two factors and two things that have happened in the industry. One is how much fees came down, and I think the colleagues from Vanguard contributed to this quite significantly, maybe not to everyone's happiness. And the other one is also how much the implementation cost came down. So how much the trading cost of ETFs came down, making the total cost of ownership really attractive and comparable to other types of investments that can be used.
Yeah, and actually, core asset allocation is one of the more interesting uses by institutions, right? Because oftentimes they can get access or traditionally in a cheaper way. So that is actually quite a novel, emerging use of ETFs. Right?
Absolutely.
Yeah, and Thomas, you're of course facing clients in your role, people like asset managers, family offices. When you pitch them on the idea of ETFs here in Europe, is there what's their reaction? I mean, is there resistance? Why isn't everyone using ETFs already in Europe?
I think let's call it the institutional professional buying cohort is pretty broad, so it's not easy to give an answer. European investors, in particular the professional buyers, buy or not buy ETFs. It's kind of a wide distribution. I think, just to Slav's point, yes, there are, multi-asset portfolio managers are usually the ones who are very familiar with ETFs. They have used them for years. If I look into this room, many of those sitting here actually have used ETFs early on as building blocks. So they're doing the asset allocation and using a very efficient and smooth implementation, which obviously can be done through ETFs, can be done also differently. I think that has changed as well over the years. Being futures at the beginning, probably of this decade, was very heavily in use. As ETF prices came down, as also some of the mechanics of the price of a future has kind of changed due to low yield environment, ETFs came even more into favor. Then there is another spectrum, which is probably the biggest asset pools in Europe, being big pension pools, big foundations. They have just turned to ETFs, in my experience, over the last couple of years, 3 years, 2 years, 4 years, because of some of the other instruments getting, kind of relatively weaker versus ETFs, but they still use a lot of very customized mandates as well, where ETFs just don't have, the same kind of price point as a 2 billion mandate would have, right? So I think the landscape is shifting. It will probably shift further in the future, but ETFs have become an appealing instrument for a broader set of investors, definitely, over the last couple of years.
And so you mentioned multi-asset managers again. Mm-hmm. So that's kind of intuitive that they would use ETFs to hit various asset classes. What about people, equity specialists, fixed income specialists? Do you get the same? Are they starting to embrace ETFs as well, or is there still some resistance there to using?
They have embraced that for a number of years, okay, but for different purposes. They would, for example, manage their inflows. So they would manage having cash coming in from their distribution channels, but they might have to wait until the next CIO meeting where they allocate then or use a tactical change to allocate the money. But they would use an ETF, let's say, they would use a Eurostoxx 50 ETF just to equitize the cash, okay, or an S&P 500. So they have used ETFs, but in a totally different way than we talked before, right? Okay. But that was like for many, many years now. Okay. Or they would use a future, right? But as I said, the future, in particular in certain exposures, have kind of lost a bit the advantage. In other markets, they still have it. And futures are not always available as in big variety as ETFs. So they kind of have their niches or found their niches over the years where ETFs moved in other places.
Yeah. Yeah, that's good. You mentioned futures. So Ari, I wanted to turn to you. So you've got quite an interesting perspective here because you're advising on all kinds of Delta One products. So from what you're seeing, I mean, where is the growth in ETFs coming from? What niche are they filling in the Delta One space?
Yeah, sure. So perhaps we'll start with the global picture. We talked about the growth of the market. We've seen a 20% growth in terms of globally on an annualized basis over the last 10 years. A lot of that has really been fueled by, over the last 5 years, a shift from active to passive. In terms of Europe in particular, I'll draw your attention to 2017. We talked about it earlier, where it was particularly strong in terms of inflows. I think we had in the order of 100 billion of inflows. Now, a lot of that growth actually came within the equity space into regular beta products like those that track country and regional indices. And fixed income is certainly a growth area, but we didn't really see as big a growth as we expected, but it was still good, but it was equivalent to the previous year. Now, in terms of, I think what is interesting is, actually coming back to 2018, Q1 started strongly. Q2 has been somewhat weak. Now, this is not a case of ETFs not growing, but it's a case of perhaps other factors that are going on in the market. There's a lot of uncertainties, trade war fears, for example. Now, coming back to a point on interesting areas within ETFs, what we have seen is the more niche areas, we call it under the umbrella of smart beta. Specifically, if we talk about factor ETFs, we've seen ESG ETFs have seen tremendous growth over the last 2 years. It continues to see growth. Certain thematics like automation and robotics. Now, these are certain areas specific areas where we've seen sustained inflows over the last 18 months or so. So going back in terms of the growth, I think we'll continue to see strong growth in the market. Perhaps we'll see more growth in the non-core areas. As we mentioned, I think we're already seeing that in the US. In the US, I think smart beta was the biggest growth segment in 2017. There's certainly lots of upside for fixed income. I was looking at a stat where if you look at the proportion of ETFs as part of the overall market, for equities it's just around 5%, and fixed income is under 1%. So if you double that, we're looking at a 10, 15 trillion market. So I think it's going to be certainly lots of prospect for growth going forward.
Yeah, and you mentioned the thematic smart beta stuff. So there's obviously been a big marketing push behind those products, but you're actually seeing that translate into sustained flows as well.
Absolutely, yeah,
okay.
Absolutely.
Got it. And when you're advising clients, I mean, typically, how do you compare an ETF to a future or a swap? Is there an area where they typically work better, more efficiently, or is it really a case-by-case basis? How do you make that decision?
So I think it's a case-by-case basis. We have actually done a lot of work around this. We call it our Efficient Investor Series at Deutsche Bank, part of research we do. Okay. So we look across Delta One wrappers broadly, swaps, futures, and ETFs. I think to a large extent, regulations have acted in favor of listed instruments in recent times. So we have seen a shift towards not only ETFs in terms of futures as well. Now, for example, if you've had lots of clients used to trade Delta One swaps in the past, and new regulations such as uncleared margins has actually made it more difficult or less efficient to trade swaps. So we've seen longer dated futures actually increase in open interest. Now, this also benefits the ETFs. So in terms of how we think about it, now for a client who's indifferent, we have certain ways, and obviously there's a big difference between unfunded instruments and a funded instrument. So it's subject whether a client can take an unfunded position or not. So we looked at the overall perspective. If you look at an unfunded instrument, where can you actually park your cash? What can you gain out of it? And there's certain efficiencies of trading unfunded instruments through perhaps dividends, perhaps other sort of efficiencies around managing the inventory. banks' balance sheet. These are different factors that actually affect on fund instruments. Now, ETFs is obviously a bit more straightforward in that sense. You do get also fund efficiencies, but we also do within ETFs, you do obviously can compare the efficiencies between products where you have choices. So one thing I would emphasize though, so it's quite easy for perhaps someone to say, okay, an ETF is cheaper than the future or swap, but what we see is these trends change through time. So any one point, a particular product could be more expensive than the other.
Okay.
So what we advise clients is to be those who are flexible, to be more nimble, to be aware of these drivers, to make decisions, to gain the additional 30, 40 basis points.
So it's a dynamic situation then?
Absolutely.
Yeah, great. I wanted to turn to underlyings because, Thomas, I know Vanguard has some strong opinions on this, and you too expressed the opinion that an ETF is only as liquid as its underlying, right? And Vanguard sticks quite to the conservative side of the spectrum in terms of what sort of ETFs you guys are willing to roll out. How do you guys decide what's an adequate underlying for an ETF, and what's your own personal view on what ETFs should be or shouldn't be tracking?
Yes, sure. I'm happy to share that view, and I agree. We have a strong view, and sometimes we're even opposing the industry. I think for the industry, sometimes it's drawn to corners where Vanguard just says, you know, that's not an exposure we think has any value for a broader investor base, and that's always a critical thing. So I don't think so. It's right or wrong, but as Vanguard is mutually owned, is investors owned, and when I say investors owned, we look at retail investor, end investor, private investors. We have them in our kind of minds and say, we believe in broad diversification, we believe in a balanced portfolio construction, we believe in systematic risk and not idiosyncratic risk. We believe, therefore, in all markets, broad markets, in very liquid market, right? So that's where you find our range of products being very, very limited compared to others, right, where we're like tiny numbers. But we're probably well suited to manage absolutely big portfolios, but just number them very, very limitedly. Hence, we would shy away, and that's also a bit our concern, that this market has becoming an issue of product proliferation, right? You can obviously slice and dice the market very, very thinly, but then we believe that you lose some of the investment where it's invest in this portfolio. So you will find typically very broad, liquid equity as well as fixed income portfolios managed through an ETF from Vanguard.
So we won't see a Vanguard ETF holding VIX futures, for example, anytime soon?
Definitely not today, and definitely probably not in the near future. I think, you know, as has been mentioned, John Bogle has a very strong view how investors should invest their portfolios. And I think, you know, kind of past gave him right that, you know, being broadly exposed to risk premia, which are actually academically proven that you, by holding such a portfolio, you get some kind of a premium back, I think has proven him right.
And Slav, I wanted to get the market maker's kind of perspective on this. I mean, you're trading ETFs all day, you're trading underlyings. Where do you draw the line on what's an adequate or appropriate underlying for an ETF, or is there a line there, or how do you see it?
I guess we are not so much focused on the investment part of this question. We are much more focused on the liquidity part of this question, right? So the starting premise is that our job as a market maker is to make markets and to provide liquidity. So if there's a product out there that is wrapped up as an ETF, we are interested in taking a look and establishing if it makes sense to provide two-way liquidity. We do recognize that not everyone in this market is a sophisticated investor, and I think one of the best things about ETFs is how they democratize the investment space, right? So ETFs allow you to access multiple different exposures at a price point that is actually equal to the price point that institutional clients, large sovereign wealth funds, for instance, would be getting. So that is pretty phenomenal, but it means that there's responsibilities. I think those responsibilities are split within the industry, so obviously regulators and policymakers do a lot of work around ETFs as the space is growing. Issuers have to take a close look as to what is the investment objective of the product. Index providers, and that space has been regulated quite a lot, come up with methodologies that hopefully are responsible as well. From our perspective, we would look like, can we actually sustainably provide a two-way market in this product? So can we trade the underlying asset class? Can we trade the ETF? I think to what Thomas mentioned before, in many cases, you will see now that trading an ETF provides a more cost-efficient or time-efficient, in fact, access to a certain underlying asset class. This, however, in our opinion, doesn't change the fundamental premise that an ETF is a wrapper of an underlying asset class. So in the times of stress or in the times of liquidity squeeze, it might be that the liquidity will go back to what is the liquidity of the underlying asset class. It should not be worse. And in fact, I think ETFs will still play a very useful role of price discovery tool. But on the back of it, if you're investing in high-yield bonds, at the moment, you can access this via an ETF at a bid-to-offer spread that is much lower than the bid-to-offer spread of trading the equivalent basket. However, you're still investing in high-yield bonds. So there's a risk involved with that. And as long as the investor understands that risk, I think that is fine. We are finding it perfectly possible to trade underlyings and to trade ETFs. But there is probably a limit to the product proliferation. I think at the moment, we are still not there yet. But with the industry growing, I think there will be some exposures which just don't lend themselves to be an ETF, right? Like you cannot do a physical property ETF, or you cannot do illiquid asset class wrapped up as an ETF and expect that it will trade just perfect.
I think I just want to add one thing, which is good news. I absolutely agree with what you just said. But the good news is, and we heard that at the beginning of that conference, roughly 70 to 80% are actually professional buyers these days in Europe. I think that risk which you mentioned, which I also think is a risk because ETF can be bought by everyone. But as we know, the big majority of ETF buyers are professional buyers. They know this, and if they don't know it, they ask specialists how they deal with these kind of things. I call that the sunshine risk because, as I said, in particular in the fixed income space, you get basket exposure which you would never been able to if you would have to trade each individual constituent of that basket through an ETF. That's a convenience play of ETFs, which is great. But in stormy times, this falls definitely back to sometimes unrealistic or seems unrealistic spreads, which are much wider. I think as the ETF industry grows, or at least not the industry grows, but the kind of the base of investor grows, probably similar to what it is currently in the US, you face more that risk that somebody has a handle on an ETF which does not really understand the trading mechanism, the liquidity mechanism, as well as the exposure itself, right? Because an index is a strategy. You have to understand in which strategy you invest, and that's where we coming from, where I personally come from. For me, it's important that investors fully understand the investment side, but fully understand the trading side of an ETF as well, because it's kind of this dual thing of an ETF.
I think, education will be critical, right? Like education is really, really important, and there's a lot of things to that, and like data, availability of data, what was discussed on the previous panel as well. But I think regulation, broadly speaking, is moving in the direction of making it more robust, just because the industry is growing. I also think sometimes when you just go to ETF-only events, you think that ETFs are on an island, and some of the problems just affect ETFs. And I do see this very clearly because we also run a cash equities trading business electronically. And what we see there, like if I go to events that are talking about this, like you don't have transparency about how much is traded. It's not easy to actually understand how much is traded in Vodafone or where the liquidity in Vodafone is. So some of the issues that you have in ETFs that you might say, oh, ETFs are really risky and maybe difficult to understand, they apply exactly the same to other asset classes and other instruments. And I think it's important to make sure that we don't suddenly believe that we live in this bubble and all the greatest things apply to the ETF bubble, but also all the worst nightmares are in the ETF bubble.
Right.
Sorry,
yes,
can I add on the topic of liquidity? This was mentioned before. I think ultimately what we, in Europe, and it's mostly the case, is the underlying that dictates the liquidity of the ETF, because a lot of it goes through the creation and redemption process. But on the flip side, I mean, there are a few examples I'd like to draw your attention to is, for example, EWZ in the US. I think there was a point last year where the Brazilian markets fell 16%, and EWZ was able to accommodate, EWZ obviously fell accordingly, and it accommodated around 5 billion of turnover on that day, which was, I believe at that point of time, greater than its actual total assets. Now, this sort of demonstrates that actually the ETF in this example was able to accommodate additional liquidity demand without the price actually getting too much stressed. And I think it traded at almost an equivalent of the future, the Bovespa futures as well. Now, another example is obviously we had the whole XIV event, which resulted in the spike of volatility. Now, obviously, that's a niche product, and the hedging was such that it affected the liquidity of a lowly liquid market. But it was also actually important to reflect to the rest of the ETF market. I think ETF represented over 40% of trading on that day, and it was very orderly. Now, this is different to the case in August 2015 when we had the circuit breakers go, and we had dislocation because the underlyings were actually absent. So there were the arbitrage mechanism wasn't there, and there was a dislocation in price. So things are improving quite dramatically along the way. The mechanisms are in place, and we can see more and more examples of ETF functioning in an orderly manner. But as you rightly pointed out, it comes down to the user and using it in an appropriate fashion.
Yeah, and perhaps as a final question, I mean, Thomas, you said this only matters, right, in a crisis situation. Or you gave us a couple of examples when these ETFs have been tested in the past. When a client or an investor comes to you and says, have ETFs been adequately tested to withstand a crisis, a sell-off, a spike in volatility? Or do you feel confident telling them that, yes, that's the case?
I think what we have seen in the past has given us the trust or the confidence that we say, yes, I would say in very liquid, straightforward asset classes, I think we have seen a lot of those events, which, yes, if the structure is in a way that the hedging instrument is available at the same time as a market maker needs to put out prices for the ETF, it works perfectly. If obviously these two instruments are kind of regulated differently and traded on different exchanges, yeah, and then one falls, away, that's going to be different, right? However, if you don't trade the ETF, then nothing happens. I mean, that was also kind of, for me, a wake-up call that people do not understand these instruments. Just because the intraday NAV kind of builds up a premium or a discount doesn't mean you lose money if you don't trade on that prices, obviously. So I would answer your question, absolutely. I would also answer your question, it really depends on those mechanisms and on the underlying. I mean, another example is if you go into very illiquid asset classes where if you trade 23 million, a daily volume is like double the normal daily volume, you will move the NAV. You will move, obviously, the price point of the underlying because you come in or you go out with so much, which is an unusual amount, which probably can also happen. But overall, the ETFs we're talking about, the ETFs, in particular Vanguard, has to offer are, S&P 500, FTSE 100, Europe exposure, that's so liquid. There is no point that I could say, I'm not sure. We're sure. What we have seen in the past kind of gives us the comfort that the ETF trades very much in line with the underlying.
And would you guys broadly agree with that?
Yeah, I mean, I think one thing that just like the final point that I would like to make to Thomas's point, I think is ETFs are also great. He mentioned about unrealized profit or loss with ETFs. I think the flip side of that is the transfer of risk mechanism that ETFs offer. And it was mentioned before about the 5 billion trade. We did this trade for a client earlier this year, and it was absolutely interesting to see how, from a client perspective, they actually transferred the risk in $5 billion exposure, or more than $5 billion exposure in one transaction. So from their perspective, the trade was done in less than 1 minute. And then obviously to trade all the underlyings and to do all the work that needs to be done behind the scenes and to get that ETF, do all the creations and redemptions in place and deliver the shares, it took more than a day from our perspective. But the transfer of risk mechanism here is extremely efficient. And from a client perspective, once they complete the trade, they export the risk somewhere else. And that's one of the unique features of ETF as well.
Yeah, well, thanks, guys. I hope you enjoyed our chat. So a big round of applause to our panelists. And
Thank you.